Shares of Hims and Hers are down 51% from their high earlier this year. So not all that long ago, shares were trading at over $70 per share. Obviously, the stock has pulled back a ton since then. There was a pretty short-term pop when shares hit that high. And keep in mind that shares are up 114% over the past year. So pull back, and this is still a phenomenal performing stock. But I think it's worth looking at, is Hims and Hers stock just too cheap to pass up at this point? The combination of the valuation and the growth that we're seeing at the company, I think is pretty compelling. So I'm going to dig through some of the numbers. My name is Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to this video sponsor, The Motley Fool. If you go to fool.com/ASYM, they'll give you their top 10 stocks to buy right now. Let's just start with the company's valuation. I'm going to put up a few comparisons here. And this is just data that I pulled from FinChat. And this is enterprise value to sales numbers. The reason that I'm using enterprise value to sales and not price to earnings is Hims and Hers is relatively early in its growth phase. It's still focusing on growing top line revenue. It's not focusing on driving bottom line results. We're not looking for operating profit over growth. We would much rather see this be a high growth company rather than a high profit company. Now, that said, Hims and Hers is profitable. It's very rare for a company to be growing as fast as Hims and Hers is, and be profitable. So just want to note that, but I think from a valuation standpoint, the better comparison is going to be enterprise value to sales, because that just pulls out that margin piece, that focus on profit. So Hims and Hers right now, as I'm recording, is trading for a 5.4 enterprise value to sales multiple. What are some competitors? And there are no great direct competitors to Hims and Hers, but I just want to pull some other companies in the space, companies that Hims and Hers is trying to disrupt, I think is a good way to frame this. Eli Lilly has a $765 billion market cap as I'm recording today. The enterprise value to sales multiple for Eli Lilly is 17.7. So 3 times as expensive as Hims and Hers. How fast is Eli Lilly growing? In the last year, they grew revenue at 32%. Hims and Hers, over the same period of time, grew revenue 69.3%. So Hims and Hers growing faster. Yes, there's a lot of GLP-1 questions out there, but everything that we know, the financial reporting says that Hims and Hers is growing faster and is expected to grow faster again in 2025. I'll get to those numbers in just a second. Johnson & Johnson, so another big company in the medical field, not a perfect comparison, but their enterprise value to sales is 4.5. So you're getting a slightly better multiple, but they only grew revenue 4.3% last year. So basically a very, very slow growth company. Novo Nordisk, this is another company in the GLP-1 space. They have an enterprise value to sales multiple of 8.1. Their revenue grew 25% last year. So you can see just based on these comparisons, the Hims and Hers is not actually more expensive than most of its traditional pharma competitors. In fact, in a lot of ways, it's cheaper. And that's despite the fact that the financials for the company have been phenomenal. Let's just go through the most recent quarterly report. And this is just the high level numbers. You can see that I'm going to focus mostly on the full year numbers, 69% growth for the full year of 2024, up to 69%. You can see the fourth quarter numbers are much better. That was up 95% year over year. The reason for that is GLP-1s were introduced late in the second quarter. That drove a lot of the growth in the third and fourth quarter. So over half of their growth, their incremental growth, came from those GLP-1 products. Those are going to be coming off. We'll see exactly what the details are about that. Management said that they were going to stop selling GLP-1s by the end of the first quarter. Now it looks like they may be pushing on that a little bit more, but we'll get more clarity on that over the next few months. Net income for the year, $126 million. You can also see the operating cash flow, $251 million. Great balance sheet for Hims and Hers. Management even has the authorization to buy back some stock. Don't know if that's the best use of capital, but when you have positive free cash flow and you have a stock that's relatively cheap, maybe that's a good idea. What are we expecting for 2025? Well, management says that for the full year, they're expecting revenue to grow 56 to 63%. So again, you're getting a company that's trading for just 5.4 times sales, who's growing revenue at 56 to 63%. Some of that is going to come from GLP-1s. That is indicated by the higher growth rate in the first quarter of 2025. But that's still a really solid growth rate. Even if Hims and Hers is growing the core business outside of GLP-1s at, let's say, 30, 40%, that's a phenomenal growth rate for that kind of multiple. Adjusted EBITDA, they are expecting to generate pretty good margins as well, $270 to $320 million for the year. And the big thing is, I think this is proving to be more of a platform than it is just a single product company. So much of the focus on Hims and Hers over the past 6 to 9 months has been about GLP-1s and the growth from GLP-1s and then the potential deterioration of growth in 2025. But look at this. They have more products than just GLP-1s, and management says that their unit economics show a payback period from their advertising of under a year. That was the question that I had about Hims and Hers before I started buying shares in 2024. Was the company on what I would call a customer acquisition treadmill, where you're just spending money, you have high customer acquisition costs, and then you never make that money back with what you would call long-term value. So what you want to have is long-term value, or the profit that you can generate from each customer, to far exceed the customer acquisition cost. So let's say it costs you $100 to acquire a customer. If you only make $50 worth of profit off of that customer, you're losing money every customer that you buy. So you can buy a lot of growth if you're a company like Hims and Hers, but if that growth is never profitable, then you're in real trouble as a business. But what they're saying here, and what the numbers are proving long-term, is that Hims and Hers is growing the company rapidly, and it's doing so profitably.
Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now.
So when you see that turn to positive net income, you have positive free cash flow, and you still have the high growth numbers that we've seen, that's telling you that the business is working as it should. And as they expand the number of products, right now, they basically have 4 products: sexual health, dermatology, mental health, and then weight loss. Weight loss is the one that's gotten a lot of attention over the past year. And you can see that this is going to be a big business. Weight loss business is going to be $725 million, at least $725 million. But now think about that. A lot of that is GLP-1s, and that's what investors are worried about right now. Can Hims and Hers either keep the GLP-1 business, the compounded GLP-1 business, transition customers to the more expensive branded products, or move them to other products that are already in the portfolio? There's a lot of uncertainty around that. But look at the size of the rest of the business. Even at $725 million, even at the low end of the revenue guidance, weight loss is only about 32% of the company's revenue. So that's not a majority of the revenue. Majority of the revenue is coming outside of the weight loss business. And that's telling you that the rest of the business and all these economic indicators that you can see here are doing relatively well. And with that context, I think the price is just phenomenal for Hims and Hers. Let's also look at the forward price to earnings multiple. This is not necessarily the best indicator because, like I said, Hims and Hers is not focused on making a profit, but it's a PE ratio of about 59 as I'm recording today. But look at the trends for both revenue and net income. So as the company has grown, we have seen Hims and Hers get more and more profitable. Here's the other chart I absolutely love from the company. This is the trailing 12-month operating margin. You can see just a 4.5% margin today. Management has said that they're going to be able to increase that by a couple of points for the foreseeable future. So I would expect over the next 3, 4, or 5 years, they're going to be able to increase that operating margin from 4.5% to potentially 10 to 15%. That means that Hims and Hers is going to grow the top line, and they're going to get a lot of operating leverage on the business. So the profitability and the price to earnings multiple that you see today is not only going to benefit from that revenue growth, it's going to benefit from more of that revenue growth flowing to the bottom line. So I think at the end of the day, this is a very compelling valuation for a company that's disrupting a lot of pieces of the healthcare value chain. We haven't even talked today about all the ways that they're going to be able to use artificial intelligence to provide a better product, how they're operating outside of the insurance infrastructure. If you deal with the insurance infrastructure at all in the United States, you know just how complicated and messy that is. I think it can be actually less expensive for a lot of people to get a lot of treatments and a better service by going through a platform like Hims and Hers. So as they increase the number of products and move just beyond those 4 that I talked about earlier, we're, I think, going to see a lot of opportunities for growth, a lot of opportunities for margin expansion, a lot of opportunities for increase wallet share, if you will, or increase the percentage of spending that customers are doing with the Hims and Hers platform versus going to a traditional pharmacy or a traditional doctor. So I think a ton of opportunity for growth. And given the current price, yes, I think this is absolutely too good to pass up. I have been buying shares periodically over the past few months, and I'm probably going to do that again in 2025. There's a lot of noise, but given the pullback in shares of over 50%, I think this is just a great opportunity to buy a good company at a really attractive price, even cheaper than a lot of its traditional pharma competitors. But let me know what you think about Hims and Hers today. Leave your comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.